Coming up today, the market rotation continues. Is the shutdown about to end? Will the Santa Claus rally come early? Crypto bros panic? Will Congress ban insider trading? And is the idea of a 50-year mortgage a sign of the times? You don't want to miss this one, guys. Let's go. And welcome back, guys, to the Daily Market Review. First off, big thanks to everybody for the warm welcome back yesterday. I'm always blown away by the fact I've got thousands of people around the world watching this show every day. So it truly is a privilege to see you all back here again as this market rotation continues. As we can see in this checkered heat map of the Russell 2000 index, plenty of green and red across the board as the market's still struggling to find a clear sense of direction as we appear to get closer to the end of the government shutdown. The Senate just approved a funding bill, headed over to the House for the final vote as soon as tomorrow, which looking at Polymarket looks to be a done deal that the government will reopen in the next couple of days. Then we can start getting some economic data again, as the market and policymakers have largely been left to their own devices. In order to steer the ship, Goldman Sachs thinks the US jobs market has actually contracted, losing 50,000 jobs last month in October. It'd be the largest decline since the pandemic in 2020. And that could very well be adding to the persistent bearish sentiment we've been seeing in the market this year. With the amount of bears out there still outpacing the amount of bulls. And I think in addition to a weak jobs market, I think a high level of pessimism throughout mainstream media is also contributing to a lot of investors, small and big, sitting on the sidelines. As typically this level of bearishness is often associated when the economy is already actually in a recession. But the fact is corporate earnings are at all-time highs and expected to grow next year, $304 on the S&P 500, and it's pretty much been up and to the right ever since it bottomed in Q1 23, shortly after the market bottom. And as we approach the end of this Q3 earnings season, once again, the market's coming in on healthy double-digit growth. Interesting to note that S&P 500 companies with less than 50% of their revenue inside the States are actually growing earnings at a faster clip than companies that have more revenue coming from inside the States, suggesting global growth is also good as well, or at least for American companies operating overseas. In addition to records for company profit margin, also sitting at all-time highs, steadily climbing up and to the right. AI could very well take that towards 20%. And companies are using all that excess cash to buy back their own shares, decreasing the size of their registers. Simple supply and demand means that squeezes share prices higher because they have to go higher just to retain the same valuation market cap. And so US buybacks are on track to come in excess of 1.2 trillion this year. And you only have to go back 8 years and that figure has more than doubled, which again is an incredibly strong tailwind for the stock market. And so it's very possible we see an early Santa Claus rally this year. Once the fog clears on the US government shutdown, Q3 earnings is coming good. The market's still not 100%. We're going to get another Fed rate cut next month, but once we get the official jobs print, if that does come in week, first Friday, December, before the Fed meets on the 10th, that could very well seal the deal on another rate cut, which again is bullish for the stock market. And that could also cause a bounce back in market breadth, which has been lacking these last few months. Only 26% of stock outperforming the S&P 500 over the past 3 months, as it's largely been mega cap tech and a handful of other stocks driving the gains out there. But lower rates and boosted liquidity is also very bullish for crypto, especially with the pending digital assets market structure bill that could guide the future of crypto industry and further open the doors for more mainstream adoption and integration with traditional finance and all throughout Wall Street, paving the way for tokenization of real-world assets. In addition to a huge pipeline of new crypto ETFs, 155 altcoin could soon be listed on American stock exchanges, making it very easy for anybody to buy these smaller crypto coins. Also coming at a time when fund managers are still just entering crypto for the first time ever, and the market in general, investors small and large, not really buzzing about crypto. In fact, looking at Google search term crypto, it's actually near some of the lowest levels over the past 5, and that typically peaks out along with the market. And I can see that through my social media feed, with crypto bros saying the collapse continues. The market is on edge of implosion, now recommending to buy gold. But let's not forget the McRib has returned. Looking back in history, that's quite a bullish signal for Bitcoin. Every time McDonald's has brought back the McRib, cryptos went on to have a pretty good multi-month rally. And big-time crypto bull Tom Lee thinks we could see 9 to 12,000 on Ethereum by the end of the year, which is quite a bold call considering it's currently trading just over 3,400 a coin, sitting right at its 200-day MA. Definitely in a short-term downtrend here. And so if this bullish uptrend was going to find support, it should do very soon, especially the psychological $3,000 level. As Tom also thinks Ethereum will eventually hit $60,000 on the back of tokenization of real-world assets. Stocks, bonds, real estate could all eventually trade on the blockchain, making it very easy to transact in small slices as well. Tom also made a good point on Nvidia. only trading at 29 times forward earnings, which is actually cheaper than Costco, those big internet stocks that topped out in early 2000. If they did have earnings, they were trading over 100 times forward earnings. There'll also be another interesting topic on the table when the market reopens. The House is going to hold a hearing on Congress members trading stocks, a long-time controversial issue, drawing widespread criticism of those that make the law allowed to trade stocks around them, kind of like a sports game umpire, referee, betting on the teams that they're umpiring on. Of course, it doesn't make sense. The vast majority of people are against it, but according to Polymarket, it doesn't look like it's going to go through. 9% chance that US Congress members will be banned from trading stocks this year. And even though the poster child for Congress stock trading, Nancy Pelosi, just announced her retirement. After accumulating a net worth close to $300 million, it looks like her daughter, Christine Pelosi, is going to continue the tradition and building generational wealth by keeping the flow of inside information to the family running for decades to come. But it's not just stock trading of Congress members that most people take issue with, it's how old they are, rapidly increasing these last 25 years. Like Nancy Pelosi, just retiring at the age of 85, now almost a quarter of all members are over the age of 70. And that's a problem with those that make the law will subconsciously tilt it in the favor of their own generation. Have done extremely well, seemingly at a cost to millennials. When you look at the relative average house price to average income, it's the worst it's ever been, not just in America, but pretty much all Western countries. Now, unbelievably, the median age of a home buyer in America is 61, with first-time home buyers only making up about 21% of home purchases. And so the events from the pandemic 2020 really shot things apart. Huge injection of liquidity to the market really benefited those that were already asset owners at the expense of those trying to get into the market. But it's not just baby boomers that bought all their properties for 2 raspberries back in the 70s and 80s that are the cause of this problem. There's also many other factors at play, including up to earlier this year, once a new policy was able to be implemented, the amount of FHA loans, government-backed loans, making it really easy for people to borrow, often just a 3-4% deposit, no need for credit history or a bad credit history, was increased by 400% to immigrants. And again, not just an American problem, but Canada, the United Kingdom, Australia. The huge influx of immigrants has put a lot of pressure on housing markets and affordability, as supply has not been able to keep up with the huge inflow of new people. And again, that's come at a great cost to millennials in particular. And so the government, fearing a rise of socialism, just like we've seen in New York, is trying to come up with ways to deal with this problem, including a 50-year mortgage, which they're already trying to dial back as it's been met with harsh criticism and a pushback from many people online. And it's easy to understand why. Just looking at a mortgage repayment calculator, and I just entered the numbers of the average American house price at the moment, $435,000. Using a 20% deposit, a typical mortgage length of 30 years, the average mortgage rate at the moment, 6.4%. And without taking costs into consideration, just looking at the monthly mortgage repayment on these numbers here works out to be $2,176 a month, and the total interest repaid to the bank over the life of the mortgage, a little bit more than the price of the house, $435,000. But if I just change the loan term to 50 years, keeping all other numbers the same, it does help out affordability a little bit in the short term, not by much, a bit over $200 a month with the mortgage repayment going down to $1935. But look what happens to the total interest paid back to the bank, almost doubling to $813,000. And even if someone took a mortgage out when they're 30 years old, they'll be paying the bank back to their 80. They're basically just renting off the bank. So it's not surprising to see that it's not really a popular idea once you crunch the numbers. And no doubt this is a hard problem to address. It's been accumulating for decades now. Not only the massive bull market in bonds kicking off since the early 80s, when rates peaked out, given a huge structural tailwind to real estate. And this is pretty much the same picture, like I said, across the West. The decreasing cost of capital, very good for real estate. That may have actually bottomed out a couple of years ago. It was also government set laws and regulation that helped to foster investment into real estate, with tax breaks and deductions that again also gave a strong tailwind to real estate these last 20-30 years. So I don't think a 50-year mortgage is the answer. I actually agree with Favik on how to address this problem is to lower home ownership costs by slashing property taxes, the cost to maintain a property, lower electric bills by producing more energy, lower house prices by building more housing, lower inflation by cutting excess government spending, and that's how you make not just the American dream, but the dream for all young people to own their own home possible these days. As for many young people under the age of 40, it's simply not within reach. And the more that goes on for, the more we'll see a rise in socialism, people fighting back against the capital system if they can't actually participate in. Even though they may have all the education, work hard, save up, they still can't afford to buy a house. But it's not actually socialism that will address that problem. It's just dialing back the government forces that helped to create it in the first place. And again, aggressive immigration does add pressure to housing affordability all throughout the West. And so no doubt this will be an issue that persists for many more years to come. But just giving you a quick update on where major markets are at. Crude oil had that strong bounce off lows a couple of weeks ago. Seems to be defending the $60 a barrel level. We've seen uranium, another hot sector this year, have a bit of a pullback these last few weeks. The VIX continues to remain low, trading just above 17, and the S&P 500 still not all that far off all-time highs here, even though we've still got plenty small cap growth stocks, another high beta stock experiencing a sharp pullback, as we can see in the meme ETF. But there are some bullish reversal signals showing up on the chart, suggesting this downward move could be close to getting exhausted. Otherwise, just like the fundamentals, the technical setup does look bullish overall. Most sectors are uptrending, and there seems to be no major negative headlines that could be causing fear out there as we go into the bullish period in towards year end. The next big thing will just be whether the Fed is going to cut rates again next month, which if Goldman Sachs is right, the US jobs market has contracted. I would say that's almost a sure thing, as they'll be forced to move in order to help out all those people that are still struggling with the high cost of living. That's all I got for you today. Thanks very much for tuning in, and I'll see you back here again this time tomorrow. Cheers.